Okay, so we've gone over preparing the sales budget, which is the first budget you prepare in the master budget. Based on your sales volume, you can prepare your production budget and determine how many units you need to produce. Once you know how many units you can produce, then you go on to steps 3, 4, and 5, which are the manufacturing cost budgets: direct materials, direct labor, and manufacturing overhead. And really, I think direct materials is the most complicated budget. Okay. So our starting point for direct materials budget would be the quantity of direct materials needed for production. But in order to get the quantity of direct materials needed for production, actually, the budgeted production unit, so we have to get the units to produce from the production budget, multiply it by the amount of raw materials per unit. So for every finished goods unit, that's what the production units, the units to produce from the production budget is going to tell you, you need, let's say, 2 pounds of raw materials, right? So that's how we get our quantity of direct materials needed for production. So actually, our starting point is the units to produce from the production budget. Multiply that by the amount of raw materials per unit. That gives you the quantity of direct materials needed for production. So we know what we need for production. We're trying to figure out what we're going to spend to buy direct materials. Okay. So we don't just want to have the quantity we need for production. We want to have some direct materials in our ending inventory. And again, this is going to be a certain percentage of next period's quantity of direct materials needed for production. So if we add what we need for production plus our ending inventory, that gives us the quantity of direct materials we need. But we're trying to figure out what we need to buy. We don't need to buy everything we need because we had some direct materials in beginning inventory. So we subtract that, and that tells us the quantity of direct materials that we need to purchase. And as I said, the production budget is the only budget that ends in units. Okay? We know how many units of direct materials we need to buy. We're going to multiply that by what it costs per unit of direct materials. That's going to give us our total cost of direct materials purchases. So let's look at an example of this. Doing our direct materials budget for December, and we're told each unit requires 1.5 pounds of raw materials that cost $4.50 per pound. They want to have direct materials inventory at the end of each month equal to 20% of next month's budgeted direct materials to be used. Okay. So our starting point is going to be our units to produce. And we're going to get that from our production budget. So our units to produce for December was 123,500. We're going to multiply that by the amount of materials per unit. And we're told each unit requires 1.5 pounds of raw materials. So that's how we'll get our quantity of direct materials needed for production, just by multiplying. So 185,250. But that's not all we want to have in direct materials. We also want to have our desired ending inventory. And so we're told that they want to have 20% of the next month's budgeted direct materials needed for production. Okay. And so we have to then look at January. We want to know what's January's quantity of direct materials needed for production, because we want to have 20% of that in our ending inventory. So we need our January production budget. So our January production budget, we take January's units sold. We're told January would sell 110,000. Our desired ending inventory is going to be 10% of the next month. So the next month is February. So 10% of February is 120,000. So we want to have 12,000. So our total units needed is 122,000. But then we can subtract our beginning inventory. So we would have had our beginning inventory for January would have been December's ending inventory of 11,000. So 111,000 is what we have for units to produce in January. So we need to produce 111,000 units in January, and we need 1.5 pounds of direct materials for every unit. So that means in January, 166,500 is our quantity needed for production. So we want to end December with 20% of that quantity needed for production. So we want to have 33,300. So the quantity needed for production plus our desired ending inventory gives us our total quantity of direct materials needed. We're trying to figure out what we need to buy. We don't need to buy all of that because we had a beginning inventory of raw materials. So we would have started December with whatever we ended November with. And so our ending inventory for November would be 20% of December's quantity of direct materials needed for production. So we would have ended November with 20% of the 185,250, 37,050. So our quantity of direct materials that we need to buy is the quantity of direct materials needed minus our beginning inventory, 181,450. We're trying to figure out what we have to spend. So we need to multiply it by the cost of the direct materials. And we're told it costs $4.50 per pound. So if we multiply the quantity of direct materials to purchase times the $4.50 per pound, let me make that, then we will be spending $816,750 to buy direct materials. Okay, so that's the result of our direct materials budget. Okay, so next we have our direct labor budget. What are we going to spend for the direct labor it takes to make the units that we need to produce? So again, we start with the bottom line of the production budget, the units to be produced, multiply it by the direct labor hours it's going to take to make one unit, and that'll give us the total direct labor hours required. We multiply that by the direct labor hourly cost, and that'll give us our total direct labor cost. So for our direct labor budget, in this example, we start with our December units to produce. Again, we take that from the bottom line of the production budget. We said we needed to produce 123,500 units in December. We're going to multiply that by the direct labor hours per unit. And our information tells us that each unit requires 2 hours of direct labor. So if we multiply the 123,500 units, each one's going to take 2 hours. So we need to pay for 247,000 direct labor hours. And we're trying to figure out what those direct labor hours are going to cost. So we multiply the number of hours by the hourly rate, and we expect to pay $13.50. So our direct labor cost is multiplying the 247,000 hours by the $13.50 cost per hour. So we are budgeting to spend $3,334,500 for direct labor. So our fifth budget is now going to be the manufacturing overhead budget. We are budgeting all of our manufacturing costs. So the third piece is manufacturing overhead. And so our manufacturing overhead, we're going to have variable costs. That's going to be based on the number of units, and then we're going to have the fixed costs. So here's an example of the manufacturing overhead unit. So our starting point is the number of units that we need to produce, and then our variable costs are a set amount per unit, and then our fixed costs are just a set amount per period. Okay, so in this example that we've been working on, here they've given us information on the manufacturing overhead. So indirect materials and indirect labor. Okay. And we can see indirect materials, it's a set amount per unit. It's just variable. Indirect labor is a mixed cost. So there's a set amount per unit, and then there's also the fixed piece. Plant utilities is also mixed. There's the per unit amount and then the fixed piece. Okay. So our starting point on our budget, we know, is the units to produce, because that's going to determine our variable overhead. So we've got our indirect materials, that's a variable cost. Indirect labor is a variable cost, and our plant utilities. And so for the variable piece of, well, indirect materials is strictly variable. It's $2 per unit. So we're going to take the $2 cost per unit, multiply it by the 123,500 units produced to get our indirect materials cost. Our indirect labor, the variable piece is $1.10, right? And think back to when we were looking at cost behavior, and we talked about different ways to break out the mixed cost between the variable piece and the fixed piece. And we can see now why this is so important. So for indirect labor, it's $1.10 per unit. And again, we'll multiply that by the 123,500. Plant utilities, same thing. 60 cents per unit. Multiply that by the 123,500. So then we can add them up to get our total variable costs of $456,950. Now our fixed costs that are a set amount per period. So our indirect labor, we can see the fixed cost piece is $13,800. Okay. Plant utilities, the fixed cost was $4,000. Then we've got depreciation of $9,500. Insurance of $2,950. Property taxes of $3,100. So now we can get our total fixed costs. That comes to $33,350. And so our total manufacturing overhead will be the total variable costs plus the total fixed costs. Wow, I spelled that bad. Okay. So our budgeted total manufacturing overhead is going to come to $490,300.